Okay. Okay, about the chat box. If for any reason my microphone goes berserk again. I hope you're all well and trading fine. I mean, this is an interesting market. My positions are actually doing fine. I mean, this is my baby rhino, so and all my trades are fine, which is good because it gives me more time to work on my stuff, the soap, and I'm activating vol surface. Anyway, so of course this options mechanics is not the vehicle or the venue to sell my software, but of course I'm going to explore volatility surface a bit further with the help of my own software. I'm not very much satisfied with one or OV in the past, so hopefully I will be able to show very interesting stuff. Right, so let's start. As usual, there's no need for a disclaimer. This is obviously educational, so I'm not even using the Aramir standard disclaimer page. And as you know by now, this is not meant to be. So last time we talked about American options. I'm going to wrap up. That was basically the part everyone missed. So basically, American options are very seldom exercised. I checked on the internet in about 17%. So that's why I say here the probability of exercising is about 1/6. Of course, if you like me, you are more of an income trader, you know, month after month, and not an opportunistic trader. There's no motivation either to go for exercising just, you know, before ex-dividend date for calls or after an ex-dividend date on puts. That's, I mean, in any case, this is about the mechanics of it, the dynamics of options, and I'm not here to expand on strategies in a particular purpose.
Hey, Bruno, do you think that the paucity of exercise has to do with the nature of the people who trade them, or is it something else?
Yes, I mean, it is a strategy that is used by specialized funds, and sometimes you will see, if you can see on your platform, large blocks of calls being exercised. But again, that's very specific to a strategy. I would say most retail traders don't exercise. And also, if you're on the wrong side, you know, it's going to be
we lost sound.
You may be getting the notification that you've been exercised. So, hello, can you hear me?
We lost you for a little while there.
Oh, I'm sorry. I'm on fiber, but I never know what's happening. But it's good that you tell me immediately so that I can repeat. Yeah. So yes, there are large blocks, and what I was just saying is that most platforms don't actually tell you whether you have been exercised. And personally, but that's a personal preference. I don't trade American options. I don't trade stocks just because of that risk. And I'm not sure you're getting paid. Of course, American options are priced a little higher for that risk of being exercised. But I'm happy with European type options. I'm not sure whether I can answer your questions, you know, more clearly. It's like exercising is something happening, and you don't really know what's happening in the background. Platforms don't tell you, and again, I know for IB, you have to check your portfolios and see, oh, well, this one has disappeared, I got exercised. And also, I was saying that, you know, it can be an opportunistic strategy around ex-dividend yield date. And also it depends whether, if, for example, you exercise on the put and you are served stocks, you know, do you have the underlying? Don't you have it? Is it purely speculative? The actual management of exercising is a matter altogether. And I must say I haven't actually looked too much into that, but I can have another session on that. But that would be also touching on the strategy, whether you were hedged and, you know, you had those stocks they sold, and, you know, that, and it's offset, or you end up being short some stocks, you know, all those things. They're becoming too specific, and you know, there are lots of ramifications I haven't got into. What I've seen in the literature is that they are more exposed deep in the money, and that also bodes the question. Last time I mentioned the optimal frontier, or the flat frontier, that is actually used with Bjerksen-Stansland. And it begs the question really of, is Bjerksen-Stansland giving you a fair value for your options? That risk is difficult to price, and Bjerksen-Stansland is a reference for American options, and it probably does the best possible job in the form of a, you know, formal closed equation, Black-Scholes style, but theoretically, Cox-Robinson, in other words, the binomial and other variations like the trinomial models, they tend to do better, but they are extremely slow at computing, because it goes through, you get your level of accuracy by going through multiple iterations. And so it's, okay, I didn't want to show that I'm not too much a fan of American options, but, you know, you can sense it in what I'm saying. Yeah.
Yeah, I mean, I would guess that a lot of short calls are being held by kind of retail accounts that are doing covered calls, and the other side is being held by market makers who are not going to give up that, as you note, the extrinsic value.
Yeah, it's true. And exercising is giving up the extrinsic value, and there's a lot less in DITM, deep in the money calls. So that's why it's probably an easier choice to go for the underlying, because you're not giving up too much. Yeah. But at the same time, as I said, you know, there's, and that's what I showed last time. The optimal frontier is not a flat frontier, as per the Bjerksen-Stansland hypothesis. So are the deep in the money calls properly priced by Bjerksen-Stansland? I don't know. It seems that they may be underpriced. TOS used Bjerksen-Stansland. One, which I used one besides my own platform. One does everything on Black-Scholes, and because the Greeks are about the same, and if you don't really care about fair value, because, you know, the market value is what you have anyway, that may be good enough. I don't have much to say about the fair value. I mean, it's a very, I mean, if you go into the literature, and as I was showing last time, some assume that the optimal frontier is convex. Some others say it's rather concave. So the jury is out on that. anyway, going back to Black and Scholes. Yeah, I'm changing subject, but there's a link between the two. So I'm going back to Black and Scholes. There won't be too many equations. And actually, I copy-pasted from an early session, I think the first or second one. And how can we interpret the ND1 and ND2, N being the cumulative standard normal distribution? I see that. Is there someone? Is there a chat? Oh, sorry. I'm going to try and be more responsive this time if I can see the chat. No, I can't see it. I don't know where it is. Sorry about that. I'll get back to the chat later. I can't see the chat box. Yeah, so ND2 is the risk-adjusted probability that the options will be exercised, and that's the link with American options, even though Black and Scholes was not designed for American options. But, you know, being exercised, even if it's at expiration, it's still being exercised. And ND1 represents the factor by which the present value of what they call the contingent receipt of the stocks exceed the current stock price. I'm going to post that document where I just copy pasted this 2 lines. It's not a very complicated one, but that will show that for those of you who have either my own Black and Scholes spreadsheet or any other with a code, it's always interesting, you know, the calculations are made, the ND1 and ND2 are calculated, and you can extract a bit more value out of those computations. And what is interesting is that because we were talking about, you know, the probability of being exercised, I'm going to be touching now about the probability of touch. And if you remember, I mean, the box on the top right is actually from another copy paste from Wikipedia on Greeks. And basically that ND1 is the delta for calls at least. And conversely, it's ND1 minus 1 for puts, because as you all know, there's a direct relationship between the delta of puts and calls. So, oh, what did I say? Delta, it's of course delta. So what is interesting to know is that delta can be seen as the probability for an option to expire in the money. And I mean, if you build your own combos, like most of us, you know, rocking butterflies or anything else, you know that the delta of the combo is the sum of the individual legs deltas. That said, it cannot be generalized to probability of touch or probability of ending in the money, because the cumulative normal distribution is in a way a directional one. So in other words, if you are going to be hitting your strike on one side, of course, you will be further away from another one. So the delta of the delta as a sum, as the combined combo, does work, but you can't actually generalize it to figure out probability of touch or probability of ending in the money. Something that you see, and I've reviewed some videos from Testy Trade and Option Alpha and others, because, you know, I'm always kind of inquisitive and sometimes even skeptical about back of the envelope simplified formula. So I was looking at something that a lot of people know, that probability of touch is roughly twice or 2 times the probability of ending in the money. And from the literature that I subscribe to in, you know, QuantNet and other forums, it's actually a fairly good approximation. At least if in the GBM, the geometric Brownian motion model, which is an hypothesis for Black and Scholes, if there's not too much of a drift. So,
Bruno,
yeah.
Black-Scholes originally assumed a flat delta across strikes. How does the vertical skew affect that probability, or does it?
I think no one would look at the original Black-Scholes as such. The generalized Black-Scholes does take into account vertical skew or different IVs for different strikes. But I'm actually now going a bit deeper in the hypothesis of Black-Scholes that to actually construct the formula that was in the previous slide. This is already a result of a not a very complex equation, but it's actually a direct derivation of geometric Brownian motion, or sometimes that you call Wiener or Wiener process. But a geometric Brownian motion is something that I haven't actually touched on these sessions, but it does assume a random variable and a drift roughly, and we can assume that market prices follow roughly that rule. The thing is that, of course, there's a drift. Like markets are overall long-term trending upwards, and this formula or this back of envelope approximation is good and is actually very good when there is no drift. So if you trade short term and the market is roughly range trading, that probably of touch, if it's important to you. I mean, maybe it's not, but it can be for any reason, like being exercised on an American option, or because it's important in your strategy. I personally, in my Rhino brokering butterfly strategy, I don't actually look too much into probability of touch, and not even so much about probability of ending in the money, because it's a very market neutral flat delta of a large range, and I try and manage. So subconsciously, I make sure that I don't get into trouble, but it's not something that I consciously analyze on a day-to-day or week after week basis. What I'm saying is that if that kind of information is important to you, in order to minimize the drift aspect, I would say that it's probably more valid if, like many of you trade over 1 month, 2 months, and I would say that if you trade long term, like leaps, 6 months, a year or more, I would say that the formula completely falls apart. So again, it's like everything. When you study a bit of theory, check your hypothesis and check whether the environment you're in more or less equates with the hypothesis. And I'm not going to go back into the normal distribution, the hypothesis, and then of course that Black-Scholes can't do a good job when there are sudden shifts or even black swans. I mean, we know that. I mean, we all know that. So the good thing is that if you have a strike that you want to monitor a leg, your call delta or your put delta will be very much linked to the probability of ending in the money or being touched through sometime during the life of the option. So again, I'm coming back to what I said before. I mean, if you have Black-Scholes on a spreadsheet or a more open platform, and I'm not sure, maybe TOS gives it to you. I can't remember. I know that other platforms like One or OV, they always want to make it simple for you, so they package it into delta, but they don't actually give you those calculations as such, that you just relabel it as delta and that's it. But it's good to know that your delta is roughly the chance that you can be in the money. Another thing I wanted to, so that's why there's a link between delta, probability of being in the money, probability of touch, and exercising. So that's I know sometimes I go all over the show, but there is some logic in what I'm presenting today. Another little aside that came to my mind, and again, I don't always follow a very straight path when I present these options mechanics sessions. The impact of interest rates. Something I've got my demo account here, and I actually monitor the premium. For example, the premium today, cash to futures, is negative. And if we were in a, I know the interest rates have been cut 3 times this year, and I know it's a very ugly chart, but that's IB. But the important thing is to see, and I remember years back, when I used to see the premium being negative, it used to be bearish. And I've monitored that premium for quite a while, and I realized that it's purely because the interest rates are effectively negative. So I just wanted to put up 1 or 2 slides on that. And of course, there's that very, well-known equation. If you understand that there can't be arbitrage opportunities between the cash index, for example, if you trade an index and the future or forward, there's that link between the two. You discount the futures by the rate, and also you take into account Q being cost of carry or dividend. And when you have interest rates which are negative, you have the future below the spot. And again, when on a normal market environment, if R is above Q, above your dividend rate, and again, that's another thing I mentioned, maybe, but maybe not enough, on BX and Stansland. BX and Stansland actually works a lot better on FX options, because the interest rates on your currency pair, or the rates differential, is equivalent to a continuous dividend. Now, if you use in BX and Stansland a dividend stream that will be itself discounted because it is sometime in the future, whatever you do, you try and make it look like it's something continuous, but it's actually a discrete event that you try and discount back into present time. So that's another reason why BX and Stansland and dealing with dividends. But it's also the same with Black and Scholes. The dividend figure you put into the formula, and of course, like most market participants, you're going to use a value that is given by one of numerous websites. There's a kind of a consensus of what the next dividend will be like, and of course you can get it wrong, and that's exactly when you see the price shifting upwards or downwards when the dividend is being announced. But technically, and again theoretically, it works hundreds times better on a truly continuous dividend, like you get on an FX options. So again, when the interest rates are higher than the dividend, to what we're seeing today would be a bearish sign. And maybe maybe in negative interest rates are also sometime in the future a bearish sign. I mean, this is something I mean, for those of us who have been around for a while, I mean, negative rates were not part of the scene. You know, we used to have positive rates, and and it looked like normal. So the new normality to me is not exactly normal. But what we can interpret from what we seeing these days, with the future or forwards being below the cash prices, is that it's not a bearish sign. It's just an odd environment that we're in. If you now plug all of that into Black-Scholes, you will see that, of course, all other things being equal, that calls may be undervalued and puts overvalued. So that's also something that can be having consequences on the fair value of your options. So because of that negative interest rate, now that you know that maybe the pricing may not be 100% correct, what market makers do about it, they're probably just as confused as we are. But it's not exactly the best environment. Interest rates are supposed to be positive, or maybe the market is looking bearish or has some bearish anticipation, even though there's nothing in these days markets indicating the market is bearish. On the contrary. So other consequences is that your deep in the money calls can have a delta above 100, which is also unusual, and your deep in the money puts can be below minus 100. And what we can suspect is that raw, which is the Greek that we tend to ignore or leave aside, the sensitivity to interest rates, it may come back, because I don't look at this negative interest rates environment as being normal. And exactly like, and also for me, a motivation to have my own platform with my own calculations. And if you remember what I said,
we lost you again.
can you hear me now? Hello? Can you hear me? Yeah? Is it okay? Can you hear me now?
Now you're back.
Oh, okay, good. Sorry, there's something wrong with this computer with the sound. Anyway, I'm sorry. Okay, I'm glad you can hear me. What I was saying is that I don't know exactly when I got cut off, but anyway, the same way as I decided to build my own platform, because if I had VOMA at my disposal early 2018, I wouldn't have lost money on the rhinos, because there would have been all the warning signs about Vega. I mean, some people called it the Vega-geddon or something. And I suspect that that Greek that we always ignore, raw, that sensitivity to interest rates, may come back and be, I mean, to the fore, it will never be as important as Vega for us volatility traders, but that's something that's I just want to identify as something we may want to look at, and maybe not in the next month or 2 months, but there will be a shift in interest rate sensitivity probably in 2020. Anyway, this session is a bit short. I didn't have time to prepare much more on this one. So I'm quite happy that you, Andrew, you've got your mic on. So if you have any questions on American options or any other topic, in any case, this is half an hour. And generally, I would like to keep the topic as a 30-minute discussion on my side so that we can discuss about other things. So if you have any questions on anything that I've presented so far on the first 8 or 9 sessions, I mean, this is the right time. Can you hear me? Now I'm starting to be a bit, okay. Good to see you here, Gary. I mean, what have you been up to recently?
Can you hear me?
Yeah.
Oh, okay. Sorry, I had the mic off. I just been scratching my head and trying to figure out some things. But progress is kind of slow for me to develop new things. I keep looking at volatility surface and trying to figure out how I can improve my stuff, but it's just kind of a lot of details I have to keep in, make sure I have all my I's dotted and T's crossed. So I'm very slow to make changes in that respect, but I do believe there is possibly some improvement for myself if I look into volatility surface a little bit better for making estimations.
Yeah. I remember we had a chat a while back, and I was quite impressed by your graphs, you know. And of course, you are very fortunate that with TOS you don't have that very tight limitations on the number of options or symbols you request through RTD.
Correct.
And I remember you charting vols queues across a number of expiries, and it looked like it was quite a stable, shape. And I remember that we chatted about it, and of course to standardize and make, of course, I mean, if you want to model a vol surface, it will work better if you use moneyness on the x-axis than actual strikes.
Agreed.
And something that you not using, maybe you've looked into it since, is to also use a time factor in the moneyness calculation.
I do.
So, okay, and does it change the way your vol surface appears now across time frames?
Yeah, because it makes each time frame look identical, right? They appear to be parallel, which actually makes sense. And
it does make sense.
I really like that.
Yeah, I'm glad you looked into that, because to me, the simplest your vol surface will be, and then it's just changing a variable by another variable. You know, you can switch to moneyness and then switch back to strikes. You can apply a time factor, and then and the good thing is that by having the simplest vol surface, you can model it a lot simpler, and then the IV you're going to extract for a particular strike at a particular time ahead in the future the simpler the shape is, the better the model will be. And I believe we can build not only nice looking vol surfaces, but also model price projections a lot better. So
I do too. One of the things I'm sure you've noticed also, when you look at the vol surface, the further out in time you go, the calmer and more predictable things appear. It's
that's
just
correct.
that first, like 14 to 20 days, where you got, you know, a 0 to say 20 days, that time frame, the volatility has more variations that seem like noise.
Yeah, I'm not sure we can call it noise, but the responsiveness to news and shocks and
Yes,
will be a lot more visible. That's why a lot of us who trade from 28 DT to 77 or 80 DT, this is a comfort zone for us. And I always say to less experienced traders, be careful if you trade after 14 DT. I mean, it's for 28 to 14, it's still manageable, but it may be more hard work. And if you have a vol shock in the last 14 to 21 days to expiration, I understand. I mean, I agree completely with you. And it shows when you look at the vol surface. The skew steepens, and you tend to have a nice looking, almost like I mean, by using the right variables, it looks like a valley across time, but it is true that on shorter time frames, the cliffs can actually narrow down. I mean, you can be in a very, very odd situation. And yeah, I understand what you're saying. Yeah.
Yes, it's just there's more moving parts there that because that's still moving around, I kind of tend to not trade in that area because there's a lot more I need to learn, right, to trade those shorter time frames. So the longer time frames appear more stable, predictable, I guess.
Yeah, I agree with you. And again, unless you are very opportunistic and you want to trade according to a conviction or a bias, that's fine. But you know, you've got that. That's also something I mentioned in an earlier session. You've got that dilemma between gamma and theta. So you've got theta picking up very strongly late in the trade, but your gamma also, and there's no way you can really. I mean, I explained that in an early session, and both are intertwined very tightly. So the only way to deal with short-dated options is, in my view, of course I could be wrong, you know, I mean, is that you must try and keep your gamma under control. And I was showing, I'm not sure whether you were there, but I was showing, for example, my current baby rhino. This trade is supposed to be closed tomorrow at 7 DT. And I've actually reduced the trade. And some would say, well, why don't you try and make more money out of it? You know, for me, I'm happy that, and that's, for me, that's exactly what I'm at, you know, to have a flat delta, low gamma at this close to expiration. I mean, to me, I mean, some people are not sensitive to that because they don't actually see the risk. But if you're a market neutral trader, this is exactly what you would be looking at. You want to minimize your risk because it becomes quite difficult to trade. And I've tried to keep that baby rhino simple because, you know, we trade by routine. And so if people who trade the rhino can easily adjust and adapt to the baby rhino, by at least sticking to the same philosophy. But it's actually a lot more important when you trade short-dated options. Control your gamma because, and I mean, even in this instance, I actually bend the rules because I've got a slight bearish bias. I'm hoping the market will drop a bit. so that I could maybe make a bit more on Vega. But overall, this is a safe trade, and I try and keep it as safe as possible. But I fully understand what you're saying. It's a different ball game, and unless you have 10 years of experience or more, I would say don't even bother trading after 14 DT. Yeah. I'm hoping I'm actually doing the final touch on my Vol surface. I've been bogged down by API and data issues, but I've actually posted on my YouTube channel updated vertical skew with moneyness and all those things. So I know I'm on the right track. It's just that, you know, when you deal with data, and you know that as well. If you deal with TOS data, you get a lot of trouble. I mean, modeling is the easiest part, actually. When you know what you're doing, and I'm going to be modeling a 5-point and then a 7-point Vol surface, something I've mentioned in the last few sessions. I'm not sure I actually posted that Dumas Whaley paper, maybe, but I will. It's actually quite interesting, and I think you, Gary, would like that. Or if you, I'm not sure you were there last time or the one before, where I mentioned that.
Yeah, I think I just watched the recordings. I was away, and I think one time I forgot. So sorry.
Okay. The interesting part is actually not my talk, but maybe more the Dumas Whaley flaming paper dating 1998 and then updated in 2002, which is actually the basis of my research and implementation right now. And that's something you may be interested in, because it's quite simple. It's very much a practitioner's approach, non-parametric. It doesn't involve CEV and, you know, bivariate models, you know, the volatility versus the underlying. So that's what I think is the beauty in it. It's because CEV, and I know that's what is being used in option view, and I know that one is just trying to make an option view version that looks nicer, but they don't really think out of the box in terms of modeling. I don't believe in CEV because it's all based on mean reversal, and mean reversal is so difficult to time. So it's very much a statistical measure, and you never know whether you get it right or wrong. CEV, I mean, when I started with option view years ago, I looked, okay, that's cool. They've got CEV, and that's something nobody else has. But now that I've actually done my research, I realized that it's not the answer, or it may be the answer if you trade really long term, because mean reversal will happen, and the effect of CEV, or the effect of rebalancing the vol surface according to volatility behavior, may have an impact. But I'm actually now going totally opposite to you and I were just saying. I mean, there's about going short term, you know, but CEV for people like us trading over the next month, 2 months, I'm not sure it's actually of any help. Let alone the fact that on one, they do recalibrate the vol surface only once a day, and only marginally. So anyway, I will get back into that when I show my stuff and explain exactly how I implemented it. And I hope you will agree with me, but it needs to be a bit more visual than just me talking today. If you want to share your screen and show what you've been up to, and I mean, that's fine. I mean, I'm glad that I'm not just the only one talking today.
Okay. Well, I can kind of just show a vol surface that from right now, what I believe it looks like.
Okay, that's cool. Let me go back to, how do I stop? I mean, stop sharing my screen. I'm so useless with that technology.
This, let me see, I go to, if I click this,
okay.
cannot share.
Stop share. Okay, there you are.
Okay, and I'm gonna say share. I'm gonna see if I can find, is this the one? Let's see, screen.
Not many are like us, so keen on this topic. Yeah.
I'm trying to find out how to, oh, there's number 3. That's this guy. And then share. Oh, okay. Can you see a plot?
Yes, yes.
Okay, this is the put IV, and it's one I just took. It's, you know, like a couple minutes ago.
Right.
And this is all the SPX terms out to 1 year.
Yeah.
And each dot is one option. I don't know if you can kind of see it. So you can kind of rotate this around. You can look, the lines are kind of fairly parallel.
Yeah. Lovely.
I should point out that the interesting things are these along this way. This is the out of money options.
Yeah.
And this is moneyness in the x-axis.
Yeah.
And the formula is here. Moneyness, there's the formula, which includes the time factor too, and the interest rate stuff. So the ones that are in the money, I don't use. So I'm not saying that they're very accurate. I don't know if they are.
And do you take the mid because or how do you deal with the spread when it starts?
Yeah, actually, I do use the mid price.
Right. Okay.
So one of the things, I guess, if you kind of turn it on its side, right, you can see the basically the term structure, how it's still in contango, which will look pretty much identical to the big central.
Exactly.
Right. And you notice.
Sorry to interrupt. I see your moneyness formula. You don't put the sigma into your formula.
No.
Have you tried to see if it's even flatter by putting?
I'm not smart enough to understand.
No, I'm saying that if you calibrate your, I mean, a lot of people just use moneyness as the logarithm of strike of the underlying, and I see you calibrate it with the DTE, but you can also in the denominator use the ATM IV for that expiry. Have you tried plotting?
Well, that would seem to make. I've heard you mention that before, and I tried to think about it, but it's kind of like mixing the thing I'm trying to plot. Okay. Right, and I'm not smart enough to understand what I would see with that.
You've done a great job. You've done a great job, and as you said, it's probably very much correlated with Ving Central, at least for SPX. But anyway, I mean it's a detail. Yeah.
One thing I noticed with this, I don't know if you have too. If I look at this. You see how it goes concave up here? Further out I get, it kind of gets more and more concave. But that concavity seems to reduce as I get closer. So one of the things I'm wondering about is just basically trading in this range. Right? That's kind of some of the trades I'm doing now. Just put them on out here and close them in like 30 days. And I believe I haven't quantified this.
That's very true. That's very true. Yeah, and the reasons why there's some concavity can be some extra hedging activity on key points, key price levels. It's not always the case, but it's been more common lately.
Yeah. I'm thinking about maybe if I can figure out where that shouldn't exist, I can go back and do this at different points in time where it didn't exist, because I can run this on any point in time in history.
Really? I mean, does TOS give you historical data?
Right now, this is from TOS, but if I go to history, I'll use my live vol data.
Oh, of course.
But I've got them both set up the same way, so it's kind of seamless going back and forth. So
it would be very interesting to see whether you have the same kind of shape in 2015, just before the, yeah, I mean, there are, the market dynamics have changed a lot since Brexit and your presidential elections, but it would be interesting to see in case we go back to, I'm not saying that there are cycles, but it would be interesting to see the vol behavior in 2014, 2016, whether we have the same concavity. I am not sure that we do.
Yeah,
so
right now my live vol data, I only have it back into kind of mid 2016 because I got but I can go back to say late 2016 or something.
Okay. And I would suspect that when the market drops sharply, you probably lose that concavity. I think it's something that comes in. I mean, even now, we are breaking all-time highs, and we're not in the same regime as in 2017, where we had to deal with a vol crash. So there is still some good hedging activity. That is actually because it's somehow maybe 5 or 6% OTM. It's not actually visible through VIX Central. It's not visible through ATM volatility. So that's quite interesting what you're saying. So if you can go back and have a look maybe at when there were some corrections in 2016, 2017, maybe have a look at maybe February, March last year. I would suspect you. Oh, okay, you've done it already.
Well, this is just I just picked a kind of a random day. That was.
Yeah, but you can see you don't have the same concavity there.
Maybe, yeah.
Slightly straighter.
Yeah, this one actually, I've got. It goes further out in time for my live vol. My toss I truncated it like 1 year. So.
Okay.
Anyway.
Do you have the live vol core? What kind of subscription do you have?
Yeah, it's the 1 minute live vol the quotes.
Okay.
So yeah, it's pretty good, but they have you have to clean the data, and that can be sometimes painful.
Yeah, it's tedious. Yeah. Well, interesting work. I mean, thank you for sharing.
Okay, sure. Let me see if I can figure out how to unshare. Oh, here we go.
Anyway, we're getting close to an hour, and I see there's a question from Tony. In order to adjust Black-Scholes to American options, what do you add to it? Yeah, premium prices are different. The pricing for the risk of being exercised is somewhere there. I don't actually, that's what I was saying earlier. I mean, a market price is a market price. I mean, is it a fair value or not? That's what you have. And as far as Greeks are concerned, and I really looked for reasons to believe that the Greeks would be slightly different, but by and large, they are the same. So that's why it's a good, yeah, I mean, it's a good approximation to use the Black-Scholes. So yeah, pricing can be slightly different. And of course, if you start modeling and you need to populate your curves, because you only have market prices for given strikes, and you need to then be able to, extrapolate for all sorts of values for the underlying. So there may be slight calibration issues here or there, but they're generally not visible. And let's say I wouldn't blame one or OV on that. I mean, to me, it's neither here nor there. It's not important. And again, if you trade by the Greeks, like most traders do, I've really looked hard in various quant forums, and sometimes they come up with headaches type of explanations, but I haven't seen good material to motivate different Greek calculations. So to me, it's a good enough approximation. And coming back to what we were just talking with Gary, the real important aspect is volatility. So the only thing you can do better in Black-Scholes is to have a good volatility model. That's really where it's going to make a big difference. Right. It's almost 9 o'clock here in Mauritius. Dinner time, late dinner. So I'm going to leave it there. Thank you for sticking to this group. I know it's not for everyone, maybe, but you know, as I always say towards the end of my presentation, just keep thinking. And there's no better way of becoming a better trader than scratching the surface and being willing to learn. Okay, I'm going to skip next session, which is in 2 weeks' time, so close to Christmas. I think I'm going to take some time off and also focus on releasing my SOAP vol surface and stuff. So I'll see you early January. And thank you for being there. Okay. Have a nice day for you, and see you around.